Hey there, and welcome to Real Investment News. I'm Mike O'Neill. This afternoon, I want to talk about Lance Roberts' latest post that bull markets actually do die of old age. Now, earlier this month, former Federal Reserve Chair Ben Bernanke told C-SPAN, quote, "There's no sense in which the expansions die of old age. The risk of a recession is more or less constant in every year." And he is right about the fact that, in a way, markets are always at risk of falling. But after 100 plus straight months of growth that we have seen, well, there's a lot of problems that come with that. Just like a guy who's 100 years old who has a lot of medical issues that a 40-year-old might not have to face. For example, interest rates. Now, over the decades, we've seen this happen time and time again. When the Feds start hiking the interest rates, it sets a clock, which is basically represented by these purple columns, sets a clock on the coming recession, which are the green columns. Now, ever since 1980, it's been about 3 years from the first hike to the recession. However, those increases also came at a time when the GDP average was well over 3%. Right now, our GDP has been going up, but yeah, we're not even close to 3% for that 5-year average. Another sign of infection, spiking input costs. Now, when you combine those interest rate hikes that we were just talking about with a surge in oil prices, which we have seen, well, it can be a double whammy for consumers, especially for those who are so far in debt. Now, we've shown you this chart before. This shows the gap between the real disposable income and the cost of living. These blue columns here is getting bigger and bigger. So how are people filling that gap? By using credit. And with interest rates so low for so long, well, the consumer credit per capita continues to climb. And to make matters worse, these savings rates right here, this blue line, are near record lows. And then the third sign of infection, valuations. Now, these red triangles is complicated, but you can see that these red triangles show periods of excess valuation when asset prices don't actually line up with actual earnings. They usually spike right before bear markets. And yeah, we are seeing that again. So it's not age that can kill a bull market. We've had longer recoveries, but it's the symptoms that come with time that can bring it down. Now, as always, you can read more of Lance's analysis at realinvestmentadvice.com. In the meantime, I'm Mike O'Neill. Thank you so very much for watching.